Euro-dollar has been in a downtrend for quite some time, driven by two quite clear factors. The first of these factors is quite simply the fact that we've seen a slowdown in the euro area. For most of the last 18 months, the PMIs have been gradually declining during that time, and not just in the periphery where you would typically see softness appearing during times of economic uncertainty, but also right at the core of the euro area as well. You don't have to look further than Germany to see softness appearing in the economic data. Germany itself, of course, teetering on recession for the last 6 months. We have seen weakness in things like car manufacturing, which has heavily played into that. But Germany does seem to have been caught at the centre of a lot of negativity, be it trade with the US, be it a slowdown in China, be it issues with the diesel engines, which make up much of German car manufacturing. But the reason, what we're seeing as a result of this is overall economic slowdowns. And that's actually effectively weighed on the single currency throughout the last 18 months. Now, on top of that, throughout that period, we have also seen a strong US dollar. And again, there are a number of reasons for that, because we have to remember that while the US last year was raising interest rates, this year it has seen quite the opposite. And actually, in the last 3 meetings, we have seen 3 consecutive 25 basis point rate cuts. So why would we, throughout that period, continue to see a US dollar strength? And the core reason for that is quite simple. The US is still the world's reserve currency. The US it also has higher interest rates than most other developed markets across the world. So yields on treasuries are still very high. So when we have seen periods of uncertainty in the markets, the recession red flags that were appearing 3 or 4 months ago, they moved into safety. The US dollar has been quite sought after during that period. It's also been sought after while the trade war has been escalating throughout that time as well. So we've seen a period where the euro has been softening in response to weak economic data, recessions brewing across the continent, and at a time when the US dollar has been strongly sought after. But it has been a very gradual decline throughout that period. We can see that on the chart in front of you can see the declining channel, which has kind of capped any rallies that we have seen in this currency pair throughout that period. But something looks to have potentially been changing over the last month or so. Over the last month, we've started to see risk appetite improve. We've seen 3 interest rate cuts in the last few months from the Federal Reserve. Trade war relations seem to be improving. It looks as though we're now moving towards a phase 1 agreement now. There could be setbacks along the way, and it's worth cautioning against that. Already overnight, we are seeing reports that China wants many more tariffs removed as part of this phase 1 agreement, closer to $350 billion than the US is apparently considering, which is closer to $112 billion. Now, this may not be a deal breaker, but we saw back in April this year that talks did break down. So there is always a risk that this could happen again, and we could see that shift straight back towards safety. But at this moment in time, markets are not banking on that. Instead, we are seeing the euro-dollar pair eyeing up those kind of 112 levels. Now, we have seen a bit of a pullback, as you can see on the chart more recently, back towards these kind of 111 levels. It looks as though we're kind of seeing a little mini double top forming around these levels as well, with the neckline roughly around that kind of 111 level. If we do see a break lower, then that's nothing to be, I don't think that's a major concern. I still think 110 is going to be really, really interesting around these levels. That roughly coincides as well with the 50 fib also, which isn't on this particular chart, but that's roughly where the 50 fib lies as well. So this could be an interesting potential reversal point, even if we do see a pullback towards that kind of region. I still think there's some appetite to the upside in this currency pair, and if we can see a break of 112, not only does that take us through the previous peak, it also takes us through the descending channel and the 200-day simple moving average, which is one of the most widely followed moving averages that we do see across these charts. Now, that won't necessarily see us propel the pair higher like you would typically see on this chart, and the simple reason is because we are still in a very uncertain environment. We are still in a very sensitive